Welcome to Dollars and Cents with Freedman Financial, the home for financial advice in a language you can understand. Created by Marc Freedman of Freedman Financial, he and his team of certified financial planner professionals will discuss timely topics that help individuals and families make smart financial decisions. And now, get ready for this week's edition of Dollars and Cents with Freedman Financial.
Welcome back to another edition of Dollars and Cents, our weekly podcast where we provide you financial advice in a language you can understand. I'm Marion Gilman.
And I'm Christian Karcher.
And we're here to, again, provide you with financial advice in a language you can understand. We both work at Freedman Financial, located right across from North Shore Mall.
That's right, a very exciting Macy's parking lot that is now a lot quieter after the New Year and Christmas.
Did you have trouble getting out of this, getting out and getting home at night?
Yes, trying to go down the hill. There was a little bit more traffic.
A little bit of a challenge there.
Back to normal, which is good.
Much nicer, yeah. All the returns are made because that first week in January can be a little precarious as well.
That's right, and the donation centers have been exploding with people trying to get stuff out after the New Year.
You know, that's not a bad thing.
No, it's not.
That's great. And you know what? People are cleaning up maybe. So that's always, a great idea. And it's also a great idea to clean up your finances too.
That's right. At the new year, people like to make, resolutions. People like to think about, okay, let me check in on what's been going on. Because, life is happening. You're not really thinking about necessarily what's going on in your retirement accounts or your retirement plans. And some people have come up and been quite surprised as they're checking in on their New Year balances. Isn't
Absolutely. That right? For those of you who don't check your accounts all the time, I know there are some people that look daily. We don't suggest that. We don't recommend that because it can lead to a little bit of stomach turning at times. But in any event, for those of you who don't look, if you've looked at your balances recently, you might be very surprised and pleasantly surprised. We've had a few very good years.
Yeah, 3 almost at this point.
Yes.
2022 was a year where, if everyone remembers, there was a lot of inflation. They increased the interest rates.
Right.
And that really negatively impacted both stocks and bonds in that year.
Correct.
But since then, we've had quite a few years all in a row. If you look at most stock indexes from the U.S. and across the world, they're annualizing over those 3 years double digits in most cases.
Yeah, it's amazing. And so, initially in 2023 and 2024, we saw the large growth stocks, the technology stocks, really, pulling away from the pack, and they did phenomenally well. One thing that had lagged for many years was international. And last year we saw international during the second half of the year, primarily, I think, catch up and do very well, ending up even higher than the U.S. stock market did. It beat the U.S. stock market, which was a rarity. But in any event, you might look at your retirement accounts or any of your investment accounts and say, wow, look at all that money. And we have had clients that have come in and almost can't believe what they're seeing on the screen when we show them what their net worth is.
That's right, because net worths have expanded because not only are the investment account prices going up, but values of homes are going up. People are paying down their mortgages. And so those net worths rise as well.
Exactly. So, it's really tempting to look at, your account and say, wow, I've got all this money. I'm going to change my spending habits. I'm going to go buy, a fancy car, a new house, you name it, whatever it might be. But I want you to think about that, the old saying that everything reverts to the mean. So, or what goes up must come down. Mm-hmm. So there are a variety of sayings in that along those lines. And that's very true about the stock market. So although the returns have been super fantastic over the past 3 years, it's not likely to continue for the next 3 years. What's your opinion?
I think that's true. I mean, eventually we are going to have a year where it goes down. We know that for a fact.
Right.
When things are going down, Mark likes to say, We try to help people remain rational in emotional times.
Right.
There's a flip side of that coin where it can now be emotional when you say, oh my gosh, look at these returns over the last 3 years. Let's try to do something that's way out of whack with what we've planned for.
Right.
And again, we're there to try to remain rational, to say, okay, we've had 3 good years in a row. We know what we expected that the kind of average return over 10, 15-year time periods to be. We need to be prepared for the possibility and eventuality that the market will pull back.
That's right. And a 10%, a 5% pullback, a 10% pullback, we typically see those every year. Even last year, we saw a 15% pullback in the tech stocks at one point during the course of the year. But one of the things that we would like to recommend that you do when you look at those eye-popping returns and that fabulous portfolio that you now have is you want to look at it and say, how do I rebalance this portfolio so it's in alignment? And I know to many of you, it doesn't make sense to say, oh, wow, this mutual fund went way up or this stock went way up, so let's sell some of it.
Right, but again, that is the emotional response versus let's
Correct.
be rational. We know that these things go in cycles. Different asset classes perform differently, and so while the stocks have been really good for the last 3 years, maybe it's time to take some of those off the gains off and add back to the bonds to rebalance to an allocation that is appropriate for your financial plans.
That long-term financial plan. We're not looking at a year or 2 years. So, and also, if you had thought, well, you know, again, very rationally in your planning purposes, you had said, okay, well, 2026 is going to be the year in which I buy a new car, or I take out a larger amount of money to do a home repair project or a home improvement project. Now might be a good time to look and say, maybe I take some of those profits off the table and put it in something a little bit safer, so when the time comes that I need that money in the next 6 months, it's there for me.
Absolutely. And there's another flip side to this. What would you say to someone who says, okay, we've had 3 really good years in a row, well, we're due, I want to move everything to bonds and cash because I'm so scared that it will eventually go down.
And you know, that's certainly, that's the other side of the coin. Absolutely, you're right, the flip side. And once again, we do not recommend that either because, one, you never know. Growth, such as we've had, you know, stock market growth, stock growth, whatever it is, can last for a lot longer than you might ever expect. I remember in the late 1990s, there was a term coined that I think it was one of the Federal Reserve chairman coined that was irrational exuberance. And that's what they said, this market is irrational, it's just going up, it's crazy. Now they said that in 1997. Six? It was 6?
Yes.
Okay.
Yeah.
The market went up for another 4 years after that. It was not until March of 2000 that the market started to correct. And then for the next 2 years, we had the tech wreck, they called it back then, and then we had 9/11. So those declines in stocks went on for about 2 years. It didn't start to recover until 2002. So you want to be careful because, again, you can miss out on a lot if you're way too early and sell everything. So that's why we always recommend you keep a balanced portfolio, something that's going to be comfortable for you as well. So you don't have that fear of, I've got to sell everything because what if I lose?
That's right. And I always like to think about it as our clients have long retirements ahead of them.
That's right.
And so there is at least a portion of that money in your retirement account that you will not need to draw, hopefully, until you're in your 90s and maybe even age 100. So that money has a lot of time to grow. It's got a lot of time to deal with those ups and downs. So you always want some of that growth there so that you can keep up with inflation, so that you can have money down the line.
That's right. And, so many people think of their retirement as, okay, well, I'm going to retire at 65, so that's when I need this money. And you're very, that's very true that you don't need all that money right away. You need to create an income stream that's going to last you for the 30 years you might live, not take it all out at once. So you want to be very mindful of doing that and creating a portfolio that is good for a long-term horizon. When we say rebalance, yes, you want to rebalance, but you're not taking everything out, because the other side of that is when the market does start to recover, as I said that the market can continue growing for many years after you think it's already in a bubble or irrational exuberance or whatever. But what happens when it starts to, after it goes down and then it starts to recover, and what happened in 2002 is all of a sudden it turns around, and boy, does it turn around. I mean, we saw that in March of 2009 after the financial crisis. The market turned around, and within a few days it had recovered substantial amount of money right away.
Yeah,
So.
I like to think about our plans. We build our plans to be able to handle the normal ups and downs of the portfolio
Correct.
we use.
That's correct.
We don't build our plans to be able to handle getting out and missing the most important recovery.
That's right.
That is what can ruin a plan versus just those normal ups and downs if you stay with it.
Absolutely. So, again, you want to stay rational in emotional times. And, we are here to assist our clients in doing just that. So if now's the time for you to get serious about your money, give us a call, 978-531-8108. That's 978-531-8108. No better time than the beginning of the year, a New Year's resolution, to get your finances in order and create a plan for your future. Or you can visit us on the web, freedmanfinancial.com. That's Freedman.
2 E's and a D.
Financial.com. You can sign up for our weekly newsletter. Comes out at 10:30 every Friday morning. You scroll to the bottom of any page on the website, put in your email address, and you can sign up for that newsletter. And once again, that newsletter provides you with financial advice in a language you can understand. Have a wonderful day and Happy New Year to all.
Happy New Year.
Enjoy.
During today's episode of Dollars and Cents with Freedman Financial, your host may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.